Hello, everyone. Again, Alan Osmolewski. Thank you for everyone for joining our call here today. I'm a partner in the tax practice here at Bloom, and along with two of my colleagues, Andrew and William, we're going to be covering some of the international tax aspects of the Tax Cuts and Jobs Act. I'm going to kind of give a general overview of the changes that have taken place as a result of TCJA for international tax, and then Andrew's going to talk a little bit about transfer pricing, and William's going to delve into the repatriation tax in a little bit more depth. But we are doing a much more in-depth deep dive in terms of international tax reform on the 26th. We have a series of other webinars coming up to look at all these topics in more depth. So if this applies to you, you may want to think about signing up for that webinar, because it's a lot of information to cover today in the amount of time we have, but we'll try and hopefully give you a broad brush overview. So in terms of changes to how the United States taxes foreign earnings of U.S. taxpayers, there's really four key areas for us to think about. And that is, there's a change to a territorial system, the repatriation tax, and we have this carrot and stick system of GILTI, FDII, we'll talk about in terms of intangibles, and then the B tax. But to kind of set the stage, how we got to where we are, for many years now, if not decades, both parties have realized that U.S. tax rates are much higher than the rest of the world. There's U.S. corporations that are keeping trillions of dollars off seas, limiting the amount of innovation and investment happening in the U.S. economy. And so the system that was in place previously was a system of worldwide taxation, where the United States would tax a U.S. corporation's worldwide income. There was a mechanism for deferral in that until a foreign subsidiary paid a dividend back to its foreign parent, that income was not included in the U.S. But as an example, if you're Apple Computer and you are paying tax in Ireland in a low tax jurisdiction, call it even 5-6%, if you pay a dividend back up to the U.S. parent, that then becomes taxable at 35% in the U.S. under the old regime, with the credit being allowed for the taxes paid to Ireland, making that then going from an effective rate at a low tax jurisdiction to 35% in the U.S. So U.S. corporations had a lot of incentive to keep earnings offshore, to not invest in IP in the U.S. where the earnings from it would be taxed at a higher rate, et cetera. That being said, most other OECD countries, if not all OECD countries, use a territorial system. And that's what the U.S. has switched to effective, with the passage of this new act, where now when a U.S. parent has a foreign subsidiary pay back a dividend to the U.S. entity, it's given 100% dividends received deduction for that. So there's no second tax owed, subject to a couple limitations we'll talk about, but that's a big change now. So now that incentive and disincentive to keep those foreign earnings out of the U.S. In many respects has gone away. I think it's important to note that this dividend received deduction does not apply to S corporations. So that can be something if you're a U.S. S corporation with a lot of foreign subsidiary activity and want to bring that back to the U.S., that's one thing to consider. So that's the first topic, is the change to a territorial system. How we get there is this tax on accumulated foreign earnings. And this is what's being called the repatriation tax. And it's a one-time toll charge on previously untaxed foreign earnings. So now U.S. taxpayers have to go back and analyze their previously untaxed foreign earnings going back to 1986, which is a bit of a challenge in some cases, and then and determine what that number is. What's their previously untaxed foreign earnings that are now subject to tax in the U.S. And as noted on the slide, they can net accumulated losses with earnings in terms of determining that net number. And so this repatriation tax, it's taxed at a reduced rate. Once you figure out what your total foreign E&P earnings and profits is for the applicable period, going back to the last time the law was changed, of this magnitude, you then have two buckets. You have things that are considered liquid assets, which is cash equivalents, receivables. Those are taxed at 15.5%, and then whatever's left is sort of taxed at 8%. Now you are able to use foreign tax credits to offset some of this repatriation tax. So a U.S. company that had foreign earnings that were in a high tax jurisdiction, Germany and France as an example, after foreign credits, their effective tax rate on this repatriation could be 2, 3, 4%. So it isn't that burdensome. And you have now companies like Apple that are saying this is they're embracing this because for them this is a tax holiday. They can bring back a lot of money into the U.S. and pay a relatively low rate. You have other companies that are saying this is confiscatory and that they were never planning on bringing this back to the U.S. But now they're having to pay tax on 30 years worth of earnings. So there's pros and cons. Tony's going to talk about the state tax implications of this later, but that's a big question mark in terms of how the states are going to treat all this. So the good news is you get up to an 8-year deferral in terms of this repatriation tax. It's a graduated payment rate. The payments in the earlier years are less than the payments in the end. As Pat mentioned, most of the things in the bill are all effective for 2018. One thing that's not, if you're a calendar year corporation, you have to compute this repatriation tax effective with your 2017 corporate return. So, the first installment of this repatriation tax could potentially be owed April 15th of 2018. A little different for fiscal year-end taxpayers, but that's something that a lot of companies are having to scramble with to address that, not just in terms of planning for the tax filing deadline in April, but also from a GAAP financial reporting standpoint. Again, we'll talk about state and local a little bit later, some more. So the next acronym we have to talk about is the Global Intangible Low Taxed Income, which is GILTI. It's kind of an interesting creative acronym that some Senate staffer came up with. And it applies to more than just intangibles, but the intention is between GILTI and its counterpart FDII is to sort of have a carrot and stick approach to encourage U.S. companies to invest in the U.S. in terms of developing technology and IP, and maybe move some of their existing IP into the U.S. And so this GILTI income amount it's basically based on an OECD concept that income earned over a deemed base amount. Maybe we can go to the next slide, please. That's an amount earned over a deemed routine amount. And the concept is if you take your foreign tangible property times a 10% number, and that 10% number is nothing scientific, that's what the OECD uses, that's deemed to be your routine return, and anything above that is implied to be from an intangible asset, whether it's IP, goodwill, etc. And this GILTI tax imposes, requires a U.S. company to include in their U.S. return any foreign profits above this threshold. So this is really another type of minimum tax per se, because if you have a foreign subsidiary and all they have is IP, they have no hard assets, all that income is going to be GILTI. Next slide, please. And so this GILTI amount is included in U.S. income, but a 50% deduction is allowed against it. Included with that is this the mirror image of GILTI is FDII, which is foreign derived intangible income. So foreign derived intangible income is income earned by the U.S. entity from sales to unrelated foreign customers that exceed this routine amount, which again, this would be 10% times their tangible assets in the U.S. And so you're allowed a deduction of 37.5% of that foreign sales income. And this all revolves around this 13.125% rate that you'll see come up a little bit here. So this is kind of the minimum tax on foreign earnings that the way the GILTI works is if a company pays at least 13.125% tax on that in another jurisdiction, because they're getting a 50% deduction on the U.S. return for GILTI, their U.S. rate becomes 10.5%. That's half of 21%. And they're allowed a credit. Now, the foreign tax credits available for this are up to 80% of foreign taxes paid. So if you take 80% of 13.125, you get 10.5%. So that's why if you pay at least 13.125% on it, you really shouldn't have to pay any additional GILTI in the U.S. The FDII piece basically gives you a deduction of 37.5% on your U.S. income. Again, you take that number off at 21%, and you get down to, again, 13.125% potentially being paid on income generated from intangibles in the U.S. Next slide, please. So again, this in theory, this provides the carrot of a U.S. company being able to pay as little as 13.125% tax U.S. on U.S. generated IP income, and the stick is they could be paying tax on foreign income if that IP is overseas and they're paying a reasonable amount of tax on it. GILTI and FDII deductions don't apply. They only apply to C corps. They don't apply to individuals or S corporations. So that's something to think about there in terms of entity choice. So again, we kind of went through this. It gets to the 13.125%, which is what Congress thought was a reasonable tax, and essentially is serving as a minimum tax in foreign taxes. Next slide, please. S corporations again are required to compute all income in the same manner of individuals. GILTI income is included, and that on the repatriation tax, the dividends received deduction is not available to S corps or partnerships. So I think it's important to note that S corps and partnerships are able to make an election to defer the repatriation tax until a triggering event occurs, which is either they sell the equity interest in the company or there's an asset sale. And that's made at the individual S corp shareholder or partner level. So next slide, please. The last piece of this is the BEAT. And the BEAT is the Base Erosion Anti-Avoidance Tax. This is based, again, on the OECD concept of income tax-based erosion, that certain companies are making payments to reduce tax in the U.S. To pay less tax in the U.S. potentially. Now, this only applies to companies that have gross receipts of over 500 million or more. Does not apply to S corporations. And basically, in its most simplistic form, it applies to payments that are being made by a U.S. corporation to a foreign affiliate that would reduce its U.S. tax, that meet a certain threshold. And so what you have to do then, and these can be payments for intercompany charges, supply chain items, interest, etc. You have to compute your taxable income as though you didn't have these intercompany payments. Apply a 5% rate on that, and then compare that to what you're currently paying. And so it's basically a minimum tax for companies that are making payments to foreign affiliates. And the BEAT goes on. The BEAT goes up to 12.5% in 2026. And I should mention also that the benefit of the FDII and GILTI deductions also get reduced down the road as well. Next slide. So what does this mean for my business? Pat hit on it a little bit in terms of ASC 740. Under U.S. GAAP, a U.S. company has to report in their financial statements the effect of a change in tax law or tax rate effective with the period that it was enacted. So in this case, President Trump signed it into law in December. So the fourth quarter is when a lot of companies have to go and adjust their deferred tax assets and liabilities. The repatriation tax is recorded as a current tax expense for a calendar year corporation effective at the end of 2017. So that gets recorded as part of the 2017 financial statements with both a long-term and a short-term payable amount. There's the need to do a lot of modeling here to analyze what's the right option for you. What does this mean to you? C versus S is a topic that's coming up a lot these days, and it's really facts and circumstances based. But there's a lot of things to think about there. And if you are subject to this repatriation tax, you kind of have to go back and look at potentially 30 years of foreign earnings and profits. And we're working with our clients to help them do that, but that can be somewhat of a daunting task. Some of that foreign E&P, may have been tracked over the years in 5471s, but maybe not tracked as accurately as it should have been. So. And then, of course, there's a question mark around the state implications. So, and I'll turn it over to Andrew.
Hi, good afternoon, everyone. Say transfer pricing is essentially the pricing of goods, services, and intellectual property that is exchanged amongst related parties of a multinational enterprise. And that pricing should be arm's length. as if you were dealing with unrelated parties. And I thought I'd start with an update on what's going on with something called base erosion and profit shifting. Now you'll see here that this was issued in July 19th, 2013. So we're about to, send our BEPS child off to kindergarten. It's already almost 5 years old. But the reason why I want to talk about BEPS is because it's really the genesis of the international tax implications in this federal tax reform. And what it is the OECD countries, all 34 members, as well as some non-OECD countries, were involved in developing this 15-point action plan. And the point of the plan is to curb practices that allow multinational companies to engage in aggressive tax planning, to shift profits from high tax jurisdictions to low tax jurisdictions. You heard Alan talk about the trillions of dollars that are parked overseas. Well, what we see with this tax reform is taking this base erosion and profit shifting and getting some of that money back here into the United States. Some of the action items that were related to transfer pricing were issued after the action plan was announced in 2015. And then just last year in 2017, the OECD's transfer pricing guidelines were updated to reflect BEPS. And as a result, what we see here in the action plans is a lot more documentation requirements globally. Now, the US has always had some type of transfer pricing documentation standard. And what that is on an annual basis, you are supposed to document what your transfer pricing is amongst related parties. Globally, that wasn't necessarily the case until this BEPS action plan came along. And since it was introduced, many countries around the world have been introducing documentation requirements. And it starts with a broader master file and then a local file specific to the country that you're operating in and headquartered in, and then country by country reporting. The U.S. has introduced country by country reporting standards for companies with $850 million in average revenue. Otherwise, they've kept their documentation standards the same as it's always been. And I also wanted to discuss this transfer pricing campaign that the IRS has been engaged in. And, this campaign relates to partially due to the limited resources that they have that are transfer pricing related at the IRS, but also because this is an area where they can get more bang for their buck. And what they're focusing on is distributors located here in the United States that are purchasing goods from a foreign parent and reselling throughout the country here. And what the IRS is looking at and putting under scrutiny is the pricing of those goods and making sure that they're arm's length and adjusting the transfer pricing where necessary. And that scope has really been expanded, not to just the large companies, but also mid-sized and smaller companies. And that's very much what we're seeing with some of our own clients here at BlumShapiro. They've gone years without having an audit on their transfer pricing, and all of a sudden they're having to defend their transfer pricing if they're a distributor here in the United States. So that's something to be mindful of. Now, this brings us to the tax reform and transfer pricing. And Alan's already discussed all these fancy acronyms with GILTI and the BEAT. We'll just wanted to show, transfer pricing has, does touch on each one of these issues to some degree or another, and kind of dates back to the BEPS action plans that were introduced a few years ago. So we can go to the next slide. So here's what you should consider in this post-tax reform world when it comes to transfer pricing. And one thing is, as a result of GILTI, you might want to consider locating your IP here in the United States. For a number of years, my transfer pricing studies had been moving IP offshore, and what should the ongoing royalty rate be, and what's the value of that intellectual property. Now with GILTI and other tax reform measures, it's really something you should be considering, is locating and keeping that IP here in the United States. And again, I stress transfer pricing documentation, not just here in the United States, but globally. You may be reading in the news about IRS resources being constrained, but that's not necessarily the true across the globe. And with BEPS and with tax reform, there's increased pressure from foreign tax jurisdictions. So I really encourage you to document whatever transfer pricing you might have. So now I'll turn it over to William, and he'll discuss the transition tax.
Thank you, Andrew, and hello, everyone. I'm William Inchoco. I'm the International Tax Practice Leader here at Bloom. I'm going to discuss the analysis or the calculation of the transition tax, and among the many significant international tax changes in international that Alan discussed, transition tax is important because this one is effective immediately, and it affects individuals and corporations. So let's look at how to analyze transition tax, and I will be using here transition tax and the term repatriation tax, because it is a transition tax because this transitions from the so-called worldwide to the territorial concept of taxation, which is embodied in the participation exception taxation on dividends that we can discuss later on. And also it's a repatriation because it is a deemed repatriation of those earnings that are parked abroad. So in this slide, we have some factual information that we're going to use in our analysis. In this slide, we have a US parent with two controlled foreign corporations, CFC1 and CFC2. CFC1 and CFC2 are both specified foreign corporation under the new rules, or SFC. CFC1 has post-86 accumulated earnings and profits, or ENP, of 1,100 and a tax of 50. CFC2 has post-86 accumulated ENP of 750 and a tax of 50 as well. Note that at the heart of this transition tax calculation is the concept of earnings and profits. ENP is a term of art that is really not defined by the code, but whose determination is or the procedure for calculating is found in the Internal Revenue Code and the corresponding regulations. The next step is to determine which ENP amount is greater. The average of the ENP determined at 12/31/2015 and 12/31/2016, or the amount determined as of 12/31/2017. In our example, the amount as of 12/31/2017 is greater than the average of the 2015 and 2016 amount, so that the 2017 amount will be taken into consideration in determining the transition tax. Note that in our example here, the ENP is bifurcated between cash and non-cash. The bifurcation is required because the new law provides for a specific tax rate, as Alan discussed earlier, for cash and another rate for non-cash. In our example, the cash amount is 1,200 and the non-cash is 650. Let's go to the next slide. The next slide is just to show you the steps in this calculation. This is a little bit tricky and actually complicated. And as a matter of fact, most of those calculation for GILTI and BEAT and FDII are very formulary and very, very complex. Let's go to the next slide. So to continue our analysis, in this slide we have, if you can see at the lower part, we have two columns, the cash and the non-cash columns. We know that our cash ENP is 1,200 and our non-cash is 650. Next, we determine what is taxable DFI or taxable ENP. DFI is deferred foreign income. To determine the taxable DFI or taxable ENP, we need to deduct the amount that is allowed to be deducted from the gross DFI or gross ENP. The allowable deduction percentage is 55.7% for cash and 77.1% for non-cash. These percentages are arrived at by tax affecting the 15.5% for cash and 8% for non-cash, which are provided by the new statute, by 35%, which is the statutory rate as of 12/31/2017. At the top of the slide is the formula. By the way, please note that there is a typo error in the formula. The allowable deduction percentage for non-cash should read 77.1 and not 71.1. Let's look at the cash column here. The allowable deduction is 668.4, and deducting this amount from 1,200, the taxable DFI or ENP is 531.6. The next step is to add the so-called Section 78 gross-up amount. Note that the transition tax allows a tax credit for the foreign taxes paid on the ENP, but only to the extent of the taxable ENP. In other words, the foreign tax credit is allowed, but only in proportion to the ENP that is being taxed. Thus, in our example, the allowable foreign tax credit is 44.3, which is 44.3% of the total tax pool of 100, as shown in the other slides, the other side that I just mentioned. Note that under the rules, the FTC, the foreign tax credit, must be included in determining the taxable income, and technically this is called the Section 78 gross-up amount. So the 78 gross-up of 44.3 is added to the taxable DFI or ENP to arrive at the total taxable deferred foreign income. In the example, the total DFI is 575.9, which is the 531.6 plus 44.3. 575.9 is then multiplied by the statutory tax rate of 35, which is again the effective tax rate as of 12/31/2017. The US tax is 201.57. The US tax of 201.57 is offset or reduced dollar for dollar by the foreign tax credit of 44.3. Thus, the US tax, or what we call the residual US tax, is only 157.27 in this example. The same process applies to the non-cash column. Again, this example is very high level. There is no one size fits all here. Every company, every individual would have a peculiar case. So it is very important that we look at this very carefully, make sure that the calculation is correct. Thank you.